Bryon, we haven't had you on before. I wonder if you could comment on a phenomenon we've seen in the last few weeks. We've talked about it last 2 or 3 weeks about how the certain bond ETFs have been trading at premiums to their net asset value recently. We saw this with HYG, some of the high yield ETFs. We saw this with some of the corporate bond ETFs like LQD. And obviously, the explanation, of course, is the Fed has announced they're going to be buying ETFs, and some investors seem to be wanting to front run them, essentially, and own them at this point. But I'm wondering about how you feel about some of these occasional disconnects you see between the actual prices of these ETFs in the corporate bond, in the bond space, and their net asset values. Our guests in the last few weeks have basically said, let's hope that we get more aggressive ways to price bonds. It's not ETFs that are wrong. It's the bond pricing that's a little slow. What's your thoughts on that, just generally?
Yeah, Bob, I would pick right up on what your previous guests had said and agree with them. Fixed income delivered to the ETF wrapper gives you this massive benefit of having the efficiency of trading on the exchange, where you have that 100% transparency. You know exactly what you own, but importantly, you have what we would call price discovery. And so you have many market participants that are buying and selling, exchanging shares in the marketplace, and that tends to lead to more efficiency in pricing and give you that price discovery. And so the ETFs actually become a very accurate reflection of what's actually happening into the underlying markets. Number of
so what do the bonds have to?
Yep, go ahead.
Go ahead. I'm sorry. Finish your thought.
No, I was just going to add that there's a number of institutional investors out there that will actually use fixed income ETF trading as a proxy for pricing. In so many ways, it becomes the market due to that nature.
So Mike, what do we do here? I agree with Bryon. It's not the ETFs. Again, the ETF haters say, aha, you see, there's something broken with the ETF. It's not the ETFs. It's the bond pricing mechanism that's broken. ETFs are very accurately reflecting where the market wants to go. But we still have this question of how to price the bonds better. What can we do about this? Is it more electronic trading? Better price discovery? What's the answer to this, to close this gap?
Well, I'm not sure there's an easy answer. I think Bryon did a great job describing what's going on. But with respect to the ETF marketplace specifically, it's simple supply and demand. It's supply and demand with an arbitrage mechanism built in, and that arbitrage mechanism allows it to not become a closed-end fund, so it can control premium and discounts. But with respect to the bond market, in times of illiquidity or liquidity events, you have situations where the underlyings just aren't pricing at all. And because the ETF is there, it, as Bryon said, becomes a price discovery tool. Now, it's not all good. If you're using ETFs that are less liquid on the secondary tape and you're not skilled at trading these products using proper limit orders, it can create serious issues for the secondary market as well. But primarily, the ETF is presenting that opportunity as price discovery. And if there's no trade on the underlying, then this is the next best case. And it's not always perfect, but it's better than not having a price at all.
Yeah. All right, guys, we're going to have to wrap it up. I want to thank you both for joining us. A little complicated subject today on USO, but this was a teaching moment to let people know exactly how these things work. Sometimes people forget or they're not fully aware, and that's what we do here on ETF Edge.